Hi, welcome to chapter 13. This chapter is about equity valuation or stock valuation. And so we want to know what drives the value of stock. So many factors come into play, including how profitable the company is, we measure that by how much earnings they make, which is earnings per share, how its new products will do in the marketplace, the overall state of the economy. But what matters most is what investors believe the company's future stock price will be, or what they believe the company's future fortunes will be. So, for example, let's talk about a stock that illustrates this principle. And you may have heard of Red Hat, which is an open source software company. So the company announced its financial results in the first quarter of 2018, reporting earnings per share of 72 cents with total revenue of $813 million. Wall Street stock analysts had been expecting the company to earn 69 cents per share on revenues of $807 million. So the company's performance was better than expected. Even so, Red Hat's stock price slid by 14% in response to their earnings news. Its worst trading in 13 years. So why would investors drive down the stock price of the company that was outperforming expectations in both its earnings per share and its revenues for the quarter? The answer has to do with the company's future rather than its past earnings. In the earnings report, Red Hat had warned that investors that its earnings for the rest of 2019 would likely hit an adverse exchange rate for the currency and have lower than expected billings for its products in the year leading up to the announcement. So the stock had been doing very well prior to that earnings announcement, rising 68% compared to the overall market gain of about 13%. Moreover, despite the drop in the stock's price following Red Hat's earnings announcement, few analysts recommended that investors dump the stock. Apparently, they believe that the long-term future of the company was bright, just not as bright as they had believed before the earnings announcements. So how do investors determine the stock's value? This chapter is going to explain how to determine the stock's intrinsic value by using information such as dividends, free cash flow, price to earnings, and other valuation models. So it's a very important chapter. This chapter will be heavily influence the final exam as well. So we can talk about book value. So book value is basically the value of the company according to the balance sheet. The basic formula would be take all the assets, the value of the assets minus the liabilities, and then you're left with the equity. Divide that by the amount of, that would be the book value. The book value per share, you just take that equity value, which is also known as book value, divide by the outstanding shares, and you get your book value per share. So if the stock price, you look at the relationship of the stock price compared to the book value. So two companies, both with a book value of $5 per share, one's trading at $25 per share, one's trading at $50 per share. Which one is more correctly valued? You can't say for sure, but using book value per share only, you'd say the one at $25 would be more fairly valued than the one at $50. So the limitations of the book value, the net amount realized by selling assets of the firms and paying off the debt, which we call the liquidation value. So the book value is the same thing as the equity value, which is the same thing as the liquidation value. Now, you could also think about what the costs are to replace the assets of the firm, or this Tobin's Q, the ratio of the firm's market value to the replacement cost. So these are different ways you could look at the book value. Because why we say replacement cost is because there are assets that the company currently owns, such as buildings, land, equipment, that are valued at the time they originally purchased it. But all those assets might be double the price if you have to repurchase it today. So that should affect the value of the book value of the company as well. And so these are some of the limitations, the difference between looking at the price of the assets currently on the books versus what the real market value is. So now, so this would be just some financial highlights of Apple and Alphabet, which is the parent company of Google. So if you look at this slide, you can get just some comparables of these two companies, and this is a couple years ago, so they're drastically different today as far as a lot of these variables. But in the valuation area, we could look at price to earnings, price to book, price to sales, PEG ratio. Here are some profitability measures. These are some of the things we're going to talk about during this chapter in the valuation. But just to compare two companies, but keep in mind that when we want to think about this term I had mentioned before, intrinsic value, so obtaining a stock's intrinsic value that investors can act on is the underlying purpose of this chapter. So this chapter we're looking to calculate the intrinsic value of a company, which means what is the company really worth? The stock price can differ from that. So that's why the intrinsic value is useful, because if the stock price is $500 but the intrinsic value of the company is only $50, you should sell that stock. It's way overpriced. So the intrinsic value will let you help you to understand if the current stock price is overvalued or undervalued. So investors decide whether and to what extent the stock is overvalued or undervalued by the calculations of the intrinsic value. So they compare the intrinsic value of the current stock price to get this idea. So at the time, the stock price depends on the investor's expectations of the company's future performance. So when outlooks for the company improves, the stock price will naturally go up. So investors' expectations are a key to where the stock price is going to trade. So valuing a company is going to be based on valuing the company's future performance, not necessarily the past performance. Past performance is useful to help us predict future performance. So we have looked at other factors that can affect the company's stock price performance, including the macroeconomic and industry factors that we talked about last chapter. But for stock valuation, the future matters more than the past. So the primary reason for looking at the past information is to gain insight about the firm's future direction. Although past performance provides no guarantee of the future performance, it can give us a good idea of the company's strengths and weaknesses. So history can tell us how well the company's products have done in the marketplace, how management tends to respond to difficult situations. So the past can reveal how well the company is positioned to take advantage of things that may occur in the future. So that's why the past is important. Because the stock value depends on the company's future performance, investors use historical data to forecast key variables moving forward, to judge the stock price alignment according to the company's perspective and what they estimate the intrinsic value to be. So in order to do this, you need to forecast sales and profits. So a key to figuring out how the company is going to do in the future, of course, is forecasting sales and profits of the company. The company's future performance is based on sales and profits. So the most important aspect to consider in this regard are the outlook or the forecast you're going to develop for sales, and then that can be derived for profits. You may also need to have an outlook for cost or inflation of costs. So one way to develop a sales forecast is assume the company will continue to perform as it has performed in the past and simply extend the historical trends. So if the company has an 8% growth in sales every year for the past 10 years, you would assume that's going to happen next year as well. So once you produce a sales forecast, then you can just shift the attention to the net profits. So we can take the existing structure of the firm and we can extrapolate what the net profits will likely be, most likely by using a common size income statement. And then we could use this to help us find fill out these pro forma financial statements to get an idea where the company is going to be going, profit or earnings per shares wise. So common size income statements are really just comparing the operating results to a previous year on a percentile basis. So the common size format helps investors identify changes in profit margins and highlights possible causes for these changes. So it's a diagnostic tool for where the company is going. Now, let's advance the slide here. We talked about the expected holding period return here. So what we mentioned, what we're going to consider here is what the E to the D1. So E to the R is the expected holding period return. So this formula is going to incorporate the dividends. So here is the dividend paid, and when it says 1, we're currently in year 0, so 1 would be next year, plus the price of the expected end of year price of the stock, and the current price of the stock divided by the current price of the stock would give us the expected holding period return. And this is just an estimate of what the return could be for holding the stock, and it all is dictated by the accuracy of what next year's dividend will be, which some companies do state, and what the estimated stock price will be. Okay, and this is just an example down here of the mathematics of the formula, something that of course we'll be doing in Excel. Now, intrinsic value. So this is basically what I was talking about before. We can also look at it as one way of measuring intrinsic value as the present value of the firm's expected future net cash flows discounted by a required rate of return. Now, the market capitalization rate is the market consensus estimate for the appropriate discount rate for the firm's cash flows. So using time value of money, discount rate is really can be thought of many things. It could be the company's weighted average cost of capital, as an example. But the intrinsic value, basically, we have the market value and the intrinsic value. So the market value is whatever the stock price is. The intrinsic value is how we're going to estimate what we feel is the true value of the company, which may be different than the stock price. Now, so using this model here, which is more of a time value money model, where we're dividing by 1 plus the discount rate measured by, which is symbol K. So if we have next year's dividend and next year's stock price, add those together, divide by 1 plus the discount rate, we get the intrinsic value on the discounted future prices. If we look at say holding period H, then this equation is going to be again a present value of the dividends plus the sales price of a 2-year holding period. So we could get a discount the dividend for the first year, discount the dividend for the next year, and at the end we're going to find the holding period dividend plus the sales price divided by 1 plus K. To H would be the holding period, which would be the number of years. So it's basically utilizing time value of money to discount the cash flows, which would be the dividends and the sale price of the stock. Now, based on that, we can move into a dividend discount model, and these formulas are going to be all within this family of models called dividend discount model. So these going to be an intrinsic value based on the present value of the future dividends. Now, keep in mind that these dividend discount models were developed when the only information you had about stocks was the dividend. So before remember, stocks have been around for hundreds of years. It's only been the last 100 years or so that companies have been required to provide financial statements and information and reports to give investors information about the financials of the company. Previously to that, one of the only things known about companies may have been their dividends, or one of the things the companies may have only announced would be their dividends. So a number of valuation models were developed centered around what was known, and that was the dividends. So even though these models are older, they're not going to be particularly useful today in evaluating stocks, because stocks in the past were more concentrated on dividends than they are today, but still, nonetheless, they're still valuable models to learn and understand. So the first model, of course, with the math in this chapter, we'll be using Excel in a later video to reinforce the calculations, because it's really not of any help to review calculations in a PowerPoint slide. So I'm just going to really talk about the formulas and their impact, and then we'll show you the calculation of them later. But the first dividend discount model we'll talk about is the constant growth. So that's going to assume that dividends are going to grow at a constant rate moving forward. So this is not going to fit many companies. Many companies don't guarantee a constant rate of growth on the dividend. But some companies do, maybe utility, or some companies can make that promise. So if we had a company that says that we're going to grow our dividend at 8% every year for forever, then you could use this formula. So D1 would be next year's dividend divided by the discount rate minus the growth rate. So discount rate is sort of like the required rate of return minus the growth rate of the dividend. So the stock, this V is going to be the stock's value over here. So the stock's value is going to be greater if the company pays a larger dividend. So that makes sense. The stock would be more valuable if it pays a higher dividend. The lower market capitalization rate, which is K, which we know, I think of it as the required rate of return or the discount rate. So the lower this is, the higher stock valuation, and the higher expected growth of dividends, of course, the higher the stock price. So this is one model. We could also, let's see, for stocks, for stock with market prices equal intrinsic price, expected holding period return. So in this case, we're looking at the dividend yield plus the capital gains yield. So this is just to kind of reinforce this. I think we talked about this in another chapter, but if we have the dividend divided by the stock price plus the ending price of the stock minus the beginning price divided by the ending price, which I always call new minus old divided by old, is going to equal this D1 divided by P plus G. So these two should equal if the market price is going to be equal to the intrinsic value. So this is the intrinsic value and this is the market price. Okay, so stock prices and investment opportunities. So the dividend payout ratio. So this is the percentage of earnings that are going to be paid as a dividend, as presented as a ratio. So if the company makes $10 of earnings and their dividend payout ratio is 30%, you get $3 of earnings, of dividends, out of the $10 of earnings. If it was 40% the dividend payout ratio, you get $4 out of the $10. So the plowback ratio, the earnings retention ratio, is a portion of the firm's earnings reinvested in the business. So what we're looking at here is if the company earns $10 a share and they're going to keep and invest $8 out of those $10 of earnings, then the plowback ratio or the retention ratio is going to be 80%. So the present value of growth opportunities, so if we want to figure out their stock price, we can look at the no growth value per share plus the present value of the growth opportunities. And let's see. Let's talk about the life cycles and multi-stage models. So, the constant growth is going to assume that the company is going to be growing constantly. But since we know companies go through different growth stages and life stages of the size of the company and dividends growing based on the different stage models, there can be an adjustment to this formula where we can, make some sort of assumption of the life cycle of the company and apply that to the dividend growth model. We're not going to be calculating that, and of course that's not going to be anything that would be on the test, but it's just a different type of model that exists, assume that different levels of dividends over time. Okay. So the constant growth model states that the stock's value will be greater, 1, if the larger the expected dividend per share, 2, the lower the market capitalization K, and 3, the higher the expected growth rate of dividends. Something that I already went over, but this is a very important information or slide to know to get the basic idea of the discount, how the discount models work, and how it just makes common sense. If the dividend is going to increase, the stock should be more valuable. If the expected growth rate of dividends is going to increase, the stock should be more valuable. But if the required rate of return is higher, then that's going to that means risk. So if the market capitalization rate, which is think of it as acquired rate of return. If that increases, then the stock price is going to go down. But if it decreases, if it's lower, the stock price should go up. So this is an inverse to the stock price. Okay, so low reinvestment, high reinvestment. So if we look at reinvestment of dividends, we could see that if it's a low reinvestment rate, so here's the dividends per share versus the year. So say a reinvestment rate in the company. If the company's going to have a higher reinvestment rate, then we would expect that the dividends would start to increase over time as the money they reinvested is going to generate more money, sort of like a compound interest. So it's just showing the difference of those two. So let's move over to price to earnings ratios. So price earnings ratio and growth opportunities. So PE is a price to earnings ratio. It's not commonly known as PE. So in this ratio, how do we calculate PE? It's basically the stock price over the earnings per share is going to how we calculate the PE ratio. So if it's a $25 stock and it's $5 earnings per share, it's a $5 PE. So the companies have the PE multiple or price earnings multiple is talked about quite often in the real world. And it's a concentration on looking at two things, stock's price and the earnings per share. So the ratio of the price per share to the earnings price per share, which again stated most commonly as PE multiple or PE ratio, is a very common approach to valuing a firm. And because you have to use what we call an earnings multiplier. So the earnings multiplier is basically the PE ratio is the earnings multiplier. So if you took your earnings of $5 per share and you multiply it by PE at 10, or the multiplier of 10, you get the stock price should be $50 per share. So the stock should trade as a multiple of earnings. So it's, basically, if we could calculate the multiple projected earnings per share in the forecast, then we could calculate the stock price if we have what we feel is confident to be a stable PE ratio. So if a company with a PE ratio of 10, earnings of $5 per share, is going to have a stock price of $50 per share. So if we estimate that the stock price is going to go up to $6 per share, then we could say that if we estimate the earnings per share is going to go up to $6 per share, then we're going to then multiplying by that constant PE multiple of 10, now the stock price should be $60 per share. So every $1 increase in earnings results in a $10 increase in share price. So the procedure is pretty simple. So don't get fooled by the simplicity of this. So first of all, the challenge is forecasting the earnings per share. So earnings can be, very dependent on a lot of factors that can make earnings unpredictable. So forecasting the PE multiple is not an easy thing. And it first starts with forecasting sales and then deriving profits from the sales, as we had talked about earlier. Nonetheless, the stock valuation provides a good insight to what the company's stock will be. So the more accurate your forecast is of earnings per share, the more accurate your future stock price will be. So we could use this. So if someone was to say that we expect earnings per share to increase next year from $5 to $6, and we feel that the current market PE ratio is stable at 10, we could have a pretty good estimate of next year's stock price. So PE ratio for firm growing at a long range sustainable pace. We could use the return on equity as a way of calculating that. So in the formula, we'd want to think first. We want to think, does it fit the stock model? And when we're looking at this, how accurate has it been in the past? So for certain companies, the PE multiple is going to be more accurate than other companies for utilization and estimating future cost. Now, looking at this formula, you have to remember that if you have a high return on equity, it's going to give a good opportunity for growth. So we can verify the PE ratio increases for high plowback, which is measured by this B symbol for back, as long as it exceeds the return on equity, which is going to be hopefully exceed K. So this is going to make sense. So when a firm has a good opportunity investment, the market will reward it for a higher PE multiple, and if it exploits these opportunities more aggressively by plowing back money into the earnings for those opportunities. So that's what this ratio, this formula is basically telling us. Now let's move over to PEG ratio. So PEG ratio is going to be an extension of the PE ratio multiple. So the PEG ratio is, let me just advance the slide here. So we'll come back to that. Just let me talk about the PEG ratio. So ratio of PE multiples to earnings growth rate. So this is something favored by some mutual fund investors, specifically Peter Lynch is very favorable on this. So we know that PE ratios commonly are taken as proxies for the expected growth in dividends and earnings. So a common Wall Street rule of thumb is that the growth rate ought to be roughly equal to the PE ratio. So in other words, the PE ratio to G, which we call the PEG ratio. And this is, again, Peter Lynch was famous for talking about this, and he has a book called One Up on Wall Street, which is a great book to read if you're interested in stock valuation. So what we're saying here is if the company has a PE of 1 and it's going to have a growth rate of 1, then it would be fair, a growth rate of 1%, then it would be fairly valued. But if the company had a PE of 10 and a growth rate of 5, the company would be overvalued because you have a PEG ratio of 2. So a PEG ratio of 1 would be fairly valued, and a PEG ratio higher than 1 could be considered overvalued. So here are some, if we look at, here's an example of return on equity in the Plowback growth and PE model. So here's the return on equity. So return on equity refers to the money equity investors brought to the firm, and we're looking at it as a relationship to profits. And so if we have here a growth rates at Plowback at 0%, and the growth rate, these are the Plowback rates of 0, 25, 50, and 75%. And then we're looking at the growth rate. So we can see that the growth rate is increasing here. And if we look at the PE ratio at these 3 different levels, we can see how the PE ratio changes in relationship to the Plowback ratio and the return on equity. So again, just kind of mapping out how they affect each other. Okay, so PE ratios and stock. So if we have the price, so it should be equally valued if the price of the stock divided by the earnings equal 1 minus the Plowback percentage divided by K minus G. So all else equal, riskier stocks have a lower PE multiple and require higher required rates of return, K. So again, it's just how the model affects each other. So if we look at the PE ratio and inflation, we see that as inflation increases, PE multiples tend to decrease. So that's why we've had higher than average PE multiples over the last 20 years, because we've had lower than average inflation. Okay, so there are some pitfalls to this price to earnings analysis. So first we have to consider that the denominator in the PE ratio is the earnings. So which are how should I say, can be influenced by different interpretation of accounting rules and different utilizations of depreciation and inventory valuation. So if the accounting is not an accurate reflection of the company, then the PE multiple will not be an accurate reflection. So the way the company is going to manage their earnings and report their earnings, and how, because companies do have an effect on how they can report their earnings and how aggressively they may work to minimize their earnings in order to take on other growth opportunities that could come along with high interest charges and things like that. So when we're looking at the PE, it's a very top level number, but there's a lot of information behind it that could be not as certain, depending how the company organizes its accounting rules and principles that it applies to make their financial statements. So, and the PE ratios, of course, are going to be tied to business cycles. So in expanding economies, tends to be higher than average PE ratios, and in contracting economies, recessions, we tend to have lower than average PE ratios. So the economy can also affect how companies are how strong their multiples are going to be related to their earnings as a market risk. Okay, so here in the slide, we're talking about the flexibility of the accounting rules. So because there's some leeway in the accounting rules, this could change the amount of profit that a company displays. And keep in mind that when companies are putting their accounting statements together to pay their taxes, they want to minimize profits to reduce the overall tax payments. So that can influence the level of the PE multiple. So this discretion in managing the earnings to help managing your taxes can make a distorted earnings per share, which would mean that the PE multiple is not accurate. So if we look at earnings growth for two companies, so here is the earnings per share and the earnings growth for Con Edison, which is a utility company that provides electricity, mostly to New York, and PepsiCo. We can see that they have the growth trajectories of the two companies are quite different, where utilities tend to be a little bit more flat with their earnings per share, while consumer snacks and beverages seem to grow a little bit quicker depending on how the company is managed and how many new markets they enter. So if we look at these two as far as price to earnings ratio, so here's the PE ratios, we can see that Pepsi-Cola is moving in sometimes a more erratic direction than Con Edison because of how sensitive they are to the economy and how quickly they are to be able to grow their businesses. A lot of times utilities can't grow their businesses too quickly because they have a limitation of the area that they can have a monopoly in. So we can also combine the PE analysis with the discounted dividend models to help estimate the stock price to a horizon date. So this would be really kind of making a hybrid of these two models, which is something that can be done, but then again, you have to remember that the PE multiple is not always compatible with the dividend because a lot of stocks won't pay dividends. So other comparisons we can look at is the price to book ratio. So this is a ratio of the price per share divided by the book value per share, which we talked about earlier. So some analysts view the book value as a useful measure, as a fundamental value of a company in relationship to its stock price. So basically, a company should be within somewhat of a reasonable percentage of the actual book value of the assets of the company. So when you buy a company, you're not just paying for all the assets of the company, you're also paying for the future potential and future earnings potential for a company. So a lot of people might say that the value of a company, and this depends on the company, on the industry, on the time, on the market, but let's say our rule of thumb was a company should be 25%, the value of the company should be 25% book value, 75% future potential. So if the company had a book value per share of $10, we would say that a fair price for the company should be $40 because it's 25% will be book value, 75% will be future earnings and potential. So that's how we can kind of use book value per share as evaluating companies And the more similar the companies are to each other, like Coke and Pepsi, the easier it is to use a model like that. There's also the price to cash flow model. So in this model, earnings are reported, of course, on the income statement, and they can be affected by how the company's accounting practices are going to try to manipulate them to lower tax liabilities. But cash flow is quite different. So cash flow is going to track the actual amount of money that comes into or out of the firm, and it's not affected by the accounting decisions because it's purely money in and money out. So as a result, some analysts would prefer to use this cash flow per share rather than earnings per share to have a more accurate look of the company's economic potential. There's also price to sales ratio. So many companies are going to look at the sales of the company in relationship to the stock price. So it's going to be a ratio of the stock price to the annual sales per share. So it could be a valuation benchmark, again, good to use between many companies within the same industry. So if your company's stock price is $10 a share and you're selling 100, if you take your sales divided by outstanding shares and you have $100 per share, then your price to sales ratio, is going to be the division of those two numbers. Okay. And this is a great way to look at a company that has no earnings. So you want to see, if you don't have earnings, you could at least work with sales growth and sales. So if a company is greatly increasing its sales per share, then that's valuable too, because someday they can convert more of those sales into profits. Okay. If we look at here is the PE ratio and the price to sales, so the price to stock divided by sales times 10, and the price to cash flow. So in this chart, we see that this price to sales is a little bit more in the middle, oftentimes than not. The PE multiple can oftentimes be widely exaggerated depending on how strong the market is or how high stock prices are getting in the market. But the price to cash flow is definitely a little bit more of a smoother trend. So investors may want to look more closely to price to cash flow. I think would be a more accurate valuation for a company. Now, PE multiple is useful too, and price to sales can be useful, but you have to remember some companies, it has to look at companies in relationship to their gross profits or net profits. So companies that have a lot of sales but retain only a few pennies per dollar, this is not going to be as significant to companies that have a higher amount of earnings per sales dollar. So if they have a gross profit of 50 cents or 50%, so every dollar they earn 50 cents, the growth of sales is going to be a lot more important to the stock price than a company that has a lower earnings per sales dollar. Okay. Now, when we're talking about the free cash flow, we have a couple of formulas to look at. The cash flow for the firm, FCFF. So we could look here would be, we have a couple of formulas that also have the cash flow for equity holders. So these were a couple of shortcut formulas that we could utilize: the earnings per share, T, the corporate tax rate, or NWC, which is net working capital. So in either of these models, when you plug in these valuations, you could use them to calculate the cash flow of the company, and that can be divided by the outstanding shares to get the free cash flow per share. And then we could do estimate the terminal value of a company. So basically saying, what would be the value of a company if and when we sell? So we could take the 1 plus the free cash flow divided by 1 plus the weighted average cost of capital to the terminal year. So T here would stand for the number of years to terminate, and then the price of the stock at termination divided by 1 plus the weighted average cost of capital to the T at termination. So this could be a way of estimating the value of the company if it was to be terminated, which means we're ending the business, selling everything, or selling the business. What is the estimated value of the company upon termination? And the weighted average cost of capital is basically the the weighted average cost of the capital pool the company can utilize. Okay, so here is an example where, so suppose that we have the free cash flow for 1 million for years 1 through 4, an expected growth rate of 3%, and the weighted average cost of capital of 15%. If we put that into the model, this is just, it's 4 years that we're doing this for, we could see that the valuation would be 7,700,000. So if 500 shares are outstanding, then what is the predicted price of the stock if the firm has $5 million in debt? So we could take the fair value of the firm minus the 5 million, divided by the 500 shares outstanding, and we can get a fair price for the stock price for the company per share. So it's just another valuation model that we can work with. And the market value of equity is another such model that we could look at here. So again, if we have the, let's go back here. Okay, so if we put it into this formula, it's a very similar formula. We can calculate the market value of the equity, which is, and then using the same formula before, if we divide by the, actually here, just divide by the outstanding share, we can get the market value of the equity. And we don't care about debt. We can ignore debt at this point because it's not going to be relevant to this calculation. So we're going to, of course, a lot of these formulas we're going to look at in an Excel spreadsheet environment, which is going to be similar to this spreadsheet here that we're going to use for the free cash flow. So we'll kind of go over. It's a very lengthy and involved, but just what we're trying to say here is that the free cash flow is a better measurement of the money a company generates. So looking at that free cash flow per share or putting other variables along with the free cash flow, we can get a better idea of what the company's valuation is. Now, comparing valuation models. So, of course, there are so many valuation models, and we're really just kind of scratching the surface here on them. And the differences between them are just assumptions. So some of the valuation models fit better with certain stocks. So dividend discount valuation models would fit better with income or utility-based stocks that pay reliable dividends, where sales per share would fit better with companies that have no earnings. Cash flow, looking at free cash flow as an indicator of stock value, would be good for companies that have highly sophisticated, highly manipulative accounting systems. So, but there are what we call the discounted cash flow models. This is where in a lot of these models we saw are discounted cash flow. We're basically looking at future cash flows and discounting them to today's value. So if we have 10 future dividend payments and then a future sales price for the stock, we discount them for the amount of years out by the required rate of return or the discount rate, we're going to get a value in today's stock price. But some of the problems here is that when we're estimating the discounted cash flow, we're just that estimate of those future cash flows. So we don't know, we're not sure if they're actually going to be realized. So, but the discounted cash flow model, like most of these models, does rely on a fair amount of estimation about future results. Now, depending on what you're evaluating, real estate, plant, equipment, you have to take into account the reliability of those future earnings and sales, different growth opportunities, just this variation of future possibilities is what generally makes these valuation models less than accurate. So you're hopefully it's pointing you in the right direction. The stock price should increase or the stock price should decrease, but accurately measuring how much the stock price will be next year is never been a proven science. So a lot of these have issues with the variability of the future predictions. So now forecasting the aggregate stock market. So earnings multipliers applied at an aggregate level, the forecasting the corporate profits for the period, deriving estimated aggregate PE ratios based on long-term interest rates. So some analysts may aggregate this into a discounted dividend model. So basically, it's subjected to, if we aggregate it, we can get a better, maybe more average feel of where things are going to be. For example, if we have an aggregated PE ratio, we're basically going to look at what do we think is reasonable for the market as far as the overall PE ratio for the entire market, or maybe for an industry, and let's apply that conservatively to the company in the calculation of our results. This is looking at earnings yield versus treasury bonds. So this would be sort of like dividend yield versus treasury yields. And you'll see that they're quite similar, but they move in a similar direction usually, but they're never identical. Okay, so this is just the last slide here where we're talking about, there's also scenarios when we're doing our forecasting: pessimistic, most likely optimistic. So all these forecasting models we're talking about rely on our future predictions. So we know that that's not accurate, but maybe if we spread the model out into three variables: pessimistic, most likely optimistic, and we inputted our variables based on the likely outcomes of these three occasions, which make up all the possible outcomes, then we can kind of get an idea of how much the stock price can move in this three-window scenario. So it's not telling us exactly what the stock price will be next year, but it'll give us three really close likelihoods. Okay, so just a couple of things that, so we know, just to sum up a couple of things, we know that estimating future earnings per share is difficult because, in the valuation process, we're going to need accurate earnings per share. And we're going to need also an accurate required rate of return, or K, which sometimes we could use the capital asset pricing model to help calculate that required rate of return. That can be used when we don't. So if we don't have dividends, we could use that capital asset pricing model to calculate K for required rate of returns for companies, which can be helpful. And let me see anything. So, keep in mind that the cash flow is often, the price of the cash flow, or the price to sales, or the price to book value, which are three other price relative procedures that can help measure companies that may not fit into any of those other valuation models that we had earlier. So the price of the stock relative to the cash flow is a good indicator, and the price of stock relative to the earnings per share, or the price of stock relative to the book value per share. These are all good indicators. So when you do a valuation on the stock, you may want to put together multiple valuation formulas and talk about the usefulness of these formulas for the particular stock. So you could list 3 or 4 of the models we showed here today, and then talk about how accurate you'd feel the predictability of each model for this stock's particular case, and then maybe settling on one valuation model that would be the most useful for predicting the future price of the stock. Okay, so that's the video today for Chapter 13. Look forward to the Excel-based calculations based on this chapter, so we can kind of explore the mathematics behind the formulas in this chapter in a little bit more in depth. Okay, thank you for your time, and I hope you enjoyed the lecture.